mode.
Well, good evening, ladies and gentlemen, and welcome to this Thursday night strategy discussion for Power Options. Tonight we're actually not going to be discussing a strategy. We're going to be discussing the historical suite of tools, a set of add-on features that's available to the regular Power Options subscription in addition to the already patented search and analysis tools and the powerful portfolio tools to track your positions. The historical suite of tools are a great benefit if you're just testing out a new method, for example, if you're just trying to identify what might work for a given strategy. Those of you that are on your 14-day free trial, you do have access to the historical suite of tools during the first 14 days there, so you'll be able to take advantage of this during that 14-day free trial as well. All right, well, let's talk a little bit first about what is Power Options. Power Options, of course, is a patented suite of search and analysis tools that are designed for self-directed options investors. The tools allow you to search the universe of options in mere seconds to find only those positions that match what you want to see. Now, this is where we're really going to focus on tonight on the historical tools. The patented Smart Search Excel tool allows us to look at the current market and find only those positions that match what we want to see. But now with the historical tools, we can go back in time. And once we've created a search in a given strategy based on our criteria, we can now go back and we can test to see how that performed over time. And that's really beneficial to see, tweak, and fine-tune the different criteria that you can use in one of the various strategies that are supported on Power Options. Of course, my name is Michael Chupka. I'm the Director of Education here at Power Options. I've had the great fortune of working with Greg and Ernie Zarenner for the past 7 years. I handle most of the coaching sessions. At Power Options, we offer free coaching sessions for our trial and subscriber members. You can sign up for as many as you want to during your trial or your subscription. I've co-authored 2 books with Ernie Zarenner, one on naked puts and one on protective strategies using various combinations of married puts and collars. Oh, something got cut off there. How about that? Oh, sorry. I'm versed in all strategies on the site, even though I do not trade all strategies. Certain things such as short straddles, short strangles, and naked calls don't match my risk-reward profile, so I do not trade them. But I'm familiar in how to use the tools to help you find them if those are strategies that you're interested in. Okay, so why is it important to use historical tools? Why is it important to use backtesting? Well, first, it's a faster approach than paper trading. Paper trading is good, don't get me wrong. I advise all of our new customers to do some paper trades, get their feet wet on a various strategy. But paper trading takes a long time, doesn't it? I mean, we can sit there and we can watch the market. We can enter our trades with fake money and watch the market as the stock changes, as the option changes, and then see what management techniques we would do. But if we're trying to get a good view of how this particular strategy worked over a 3 or 4 month period, well, without historical tools, you might be paper trading for 3 or 4 months. And that's not necessarily a bad thing, but it's much faster to do the historical backtesting. Use the historical tools to backtest to see how a particular strategy would have performed. You can also review the what-if scenarios after you have a position that's been closed. So if we want to go back, we closed a position and it didn't exactly work out the way we wanted to, we can use the historical tools to go back and say, okay, what could I have done on this position at a different time frame to maybe make it a little bit more profitable? Was there a sign earlier on that I could have adjusted this a different way? And then you can use, we'll take a look later at the historical option chain that you can use to potentially run and view those kind of past changes, what would have been made. Of course, the important thing, too, is it helps you fine-tune your search criteria if you're just getting started in a new strategy. So if we're just starting out with bull put credit spreads, we know we want to be a certain range out of the money, and we know we want to look for a certain minimum return and maybe have a certain probability. We start running our searches, and we have 130 results. Well, let's keep fine-tuning it to knock that down a little bit, but now we can view how this would have actually worked historically before we start using that new strategy. And as I mentioned, it also can help assist with management techniques. When we take a look at the Smart History Excel, we'll be looking at analyzing our group results and analyzing the position. And when we get into that individual position analysis, that is going to help us view the trend over time so that we can see during the trade, when we were in the trade, when there was a stock spike or when there was a spike in the options price as well, how that could have been done, how we might have handled that. Okay. Now there's three basic tools in the PowerOptions historical suite of tools. The first is the Smart History Excel. Just as we have the search capability on PowerOptions in each strategy, the Smart History Excel allows you to run the historical searches using the same criteria setup. So if you have a specific search that you use for covered calls or use for naked puts, maybe you use for some of the credit spreads, you can go back in time and see how your search parameters would have worked for the results that were found at a given time period. It also allows you to test that methodology over time. We can make adjustments as we're interacting with the Smart History and then take those adjustments and put them forward into actual trading. Now the historical search by symbol, I use this to identify combinations one stock at a time. If I had been doing a credit spread or a debit spread, for example, but after the spread closed it didn't quite work out how I wanted to, I can go back historically and see, well, at the same time I selected this trade, what trade might have worked better on this same stock. If maybe I needed to go deeper out of the money, maybe I needed to look for a higher probability. On the day that I entered the trade, what were the other combinations on that particular stock, and how did they perform over the same time period? And the historical options chain I find can be very useful for education, especially for new options investors. The historical chain just allows us to go back in time over an extended period to see the change in the option prices and the change in the option criteria. If we wanted to look to see how the theta changed, how the gamma changed, maybe how the delta changed. I mean, one popular question I always receive from new investors or even experienced investors, they might be in a long call position and the stock moves up, but then all of a sudden they notice that their call premium is declining. Well, why is that happening? Well, the historical option chain will greatly help you view that so that you can see what parameters were changing that caused your option premium to drop even as the stock moved up. Or reverse, if you're in a long put position, in a course then the stock dropped, but your put premium didn't increase in price as much, that would help you see that as well. Now, some of the main questions that we get from customers as they start using the Smart Search tools, they start using the search tool in a given strategy, is Ernie or myself will be on the phone with a customer, and of course they'll say, well, how do I know if these are the best parameters to use moving forward? You know, which parameters should I use? What returns can I expect using this certain strategy, and can these search results make money every month? Well, that's where the Smart History Excel tool comes in. You can run those tests historically to see that maybe these aren't the best parameters. Maybe we can make some adjustments and tweak that a little bit. Maybe there are parameters that come up that we see should be used more often in a given strategy. And what returns can you expect? Well, of course, we can go back and look at that as well. Okay, so let's go ahead and navigate over to PowerOptions. And here, of course, we're looking at the main PowerOptions tools menu. And we have our various strategies here arranged by tab. We have covered calls. We have naked puts as well. We have married puts and some other strategies too. Okay, so first and foremost, let's just take a strategy. For now, let's just go into the covered call screen. When I first click on the covered call screen, we have the available tools, quick find, the current option chain, of course, the search tool to look for positions that match our criteria in the current market, the sample searches, the search by symbol, and then, of course, the backtesting tools. But before I go into the backtest tools, I want to go right into the main search tool for this particular covered call. And the reason why I wanted to link here is earlier this week we were doing a presentation. I believe it was Wednesday's Introduction to PowerOptions presentation. We went through some concepts and some ideas of what an investor might use to look for various covered call positions. And so when I first logged onto the search tool during that presentation, we were looking at one of the default searches, the initial value screen. So to show the functionality of the search tool, I simply scrolled down to the bottom of the page, and I told everyone on that line at that time that I was going to hit the Clear These Settings button, and I wanted to put in some criteria that I think might work. And to do that in the search tool for a covered call, when I'm doing a covered call, of course I'm buying stock that I'm expecting is going to stay the same or move up in price, and at the same time I'm going to look for some general criteria. Well, what I put in, I created a search where I was looking for a minimum 4% downside protection, a minimum 4% return if assigned. That's normally higher than I normally look for. I normally look for percent if assigned of greater than 2.5 or 3%. I was focused on looking at an option volume today of at least 50 contracts, Whoop, I'm sorry. Clicked the wrong button there. Hold on one second. There we go. Okay, minimum option volume of 50 contracts, an open interest of 1,000. Okay, for the stock itself, I wanted to see stocks that had at least a 7% earnings per share growth, had a PE ratio between 0 to 50, had a broker recommendation less than 2.6 that's based on the ZAC scale where 1 is a strong buy, 2 is a buy, 3 is a hold, 4 is a sell, and 5 is a strong sell. So I'm only looking for strong buy, or between a buy and hold recommended stocks. I also only wanted to see stocks that paid at least a 1% dividend and had an average stock volume of at least 750,000 shares traded per day. So these are just common criteria one might look for a neutral to bullish position. These are similar criteria that I might look for in a naked put screen, for example, possibly a bull put credit spread or a bull call debit spread. Okay, looking for some neutral bullish stocks. We're also only looking for stocks that traded above their 50-day moving average and that did not have an earnings between now and expiration because we didn't want any surprises. Well, this was just to show the functionality of the search parameters, and as you see, when I ran this search the other day, and again today, there were only 7 covered call opportunities that match this criteria, and we even have some repeats, don't we? There's 3 veil combinations in here with the 26, 27, and 28 strike on a $27.12 stock. Okay, but how would this have worked historically? Well, let's take a look. Since I saved this search in my current search field, I currently have this saved as one of my searches in the Smart Search for covered calls. When I go to the backtest now, click on the backtest, and we'll click on the Smart History Excel tool. Okay, so we're currently in the November month, and to start with, let's say we wanted to backtest this, and we're starting in November, I should say. We wanted to backtest this new strategy we just created, this new criteria set in covered calls, and see how it would have performed, let's say, over the last 3 months. So let's assume that we're going to go back to July. So I'm in the covered call. I'm going to select July 2009. Once I select the month, this days field is going to appear. And when I click the drop down here, you'll see that it shows us every trading day. Even if there is a holiday will not appear, neither will the weekends. That's why I have the big gap between 2 and 6 because we had the 4th of July weekend in there. But this one here, you see I'm hovering over the 17th of July, which has an asterisk next to it. This was the expiration date. So let's say that we're going to pretend we started opening positions Monday, July 20th, the day after July expiration. Okay? And I'm going to go ahead, and here are the available searches that I've created, and we're going to see what results would have matched that testing covered call screen that was created Wednesday afternoon. All right, so I've got my date selected. I'm in the strategy. I've got my search criteria. I'm going to go ahead and submit this into the historical screens. Wow, well, that was pretty interesting, wasn't it? We only had one result that matched that criteria, and they don't seem that restrictive, do they? And we didn't put a lot of defining criteria in there. We were looking for stocks that were trading in an uptrend just above their 50-day moving average. Maybe the limiting factor here is that percent earnings per share growth, because we've had such a limitation on, we've had stocks that were very much depressed with their earnings, and then recently they started coming back up. Maybe it was the volume that was too high. Maybe it was the percentage assigned that was too high. Whatever case, before we start changing criteria to see if we can get more results, let's just test how this worked. So on July 20th, if we ran our criteria, we would have had one result, the CXS Corp. Now, once I've run my search, if I have multiple results, I can hit Calculate Group Results. Now, we only have one result here, but let's go ahead and click on that, and it'll just show us if we applied no management techniques, what could we expected to see with this position. Okay, well, on the original date, the stock was trading at $38.94. We could have sold the August 39 call. This was on July 20th. Would have had a downside protection of about 4.5% and a percent if assigned of about 4.9%. Okay? Well, what happened? Well, CSX apparently moved up to 45.06 on August expiration. So this would have given us our return of 4.9%, and the summary is listed down here below. Okay, so we see that we were successful positions, 1 out of 1, so 100%. We earned 4.9% with that covered call, and it shows us some comparisons. During that same time period from July 20th to August 21st, the cubes were up about 5.9% general market indicator, and the SPX was up about 7.3%. So it was a good bullish trend, a good bullish time there, and we were able to get a good result out of this. Okay. Now let's go back to our screen. Now another thing that I might do from this field is individually, I can do two things. I can take a look and analyze the position. This is a different historical view. The Calculate group results, we'll see that in a month or so as we move forward in time. We'll see how this would have worked out. Okay, but here's our position again. It gives us a breakdown of the maximum and minimum position. So we made about the 4.8% return at expiration. The minimum return at one point was 0.3%, and notice that was on 720. So this stock appears must have gone straight up. Excuse me, as we enter the position, because we had the biggest loss there when we opened the position. That was probably only due to the bid-ask spread. Now as I scroll down, the first chart that I see, this is just showing us the return of our covered call position. Okay, so the return's in yellow, compared to the return on the market indicators we saw before, the QQQQ and SPX. And down below, it gives us the historical graph of the changes in the option price and the stock price. Let me roll back to the first date, and we see that we started off with our stock at around $38.94, and our option price was about $1.85 when we opened the position. Now as we move forward, we see that we had a couple of spikes here in the option price. We had a jump up to about $5.60 there on August 7th. We were going deeper in the money. The stock at that time was at $44.33. So the stock had moved up about 5 points, and the option had gained about $3.80 from when we originally sold it. Okay. Now, if we were interested in getting income, this particular or obtaining income by buying back the call if the stock dipped, we see we didn't have a lot of opportunities to do that. We would have originally sold the call at 185, but over time it never really dropped below that except for the day after. On 7/21 it went down to 180, but as the stock kept moving up it stayed in the money. But we can see on each day, if we compare this price field to the return field above, we can see that when this stock spiked on 8.7, went up to 44.33 and the option went up to 5.60, the percent return on the position at that time with the stock increase, even though the option had moved up as well, on the comparable date of 8.7 here was 4.1% for the covered call position. So on this particular one, we have a good view of what happened. Okay, we only had one trade that matched our criteria. It was successful. Let's move forward now. Let's go back into the screen. Okay, and what I'm going to do is I'm going to select another date. We just ran from July to August. Let's see if there were new positions that would have come out. Remember, August expiration was on the 21st. So let's say we just held this to expiration, let it get assigned, and then we ran this again on August 24th. Let's see. Okay, great. This is a much better sampling. We now have 6 results that would have matched our criteria. Okay, we have Navios Maritime, Royal Caribbean, ICI Bank, Cummins Engine, CMI, Arch Coal, and there's another ICI Bank. So we have 2 combinations we could have used here. ICI Bank was currently ICICI Bank was currently trading at 31.05. For our criteria, we could have sold the slightly out of the money September 32 call for about $1.40. This would have given us a 4.5% downside protection and a potential return of 7.9%. And we also could have sold the 30 call, which would have had a premium of $2.40. We're slightly in the money. This almost reverses that, doesn't it? We have a better downside protection now, 7.7%, and a slight lower percentage return if assigned, because we're slightly in the money now, of 4.7. So this is a pretty decent example. We might be able to see in some of these cases when we have this scenario, you might ask, well, which one should I enter? Should I enter the one with the higher downside protection, or should I enter the one with the better percent return if assigned? Well, naturally, that's going to depend on what the stock does, but that's one of the great features of these historical tools. We could actually go back and just look up covered calls one stock at a time and take a look at the in the money, at the money, and out of the money covered call positions, and over a year just look from expiration to expiration and then say to ourselves, okay, if I was interested in trading covered calls in this stock over the last year, what would have been more profitable for me, selling the in the money covered call over time, the at the money covered call, or the out of the money covered call? Okay? So again, we have 6 results here. Let's just go ahead and calculate group results first. We'll see how this performed over time. So from the entry point of the 24th of August, what trades were successful? Again, we had a good trading month, so this criteria is still working out for us. All 6 positions essentially hit their maximum return level. Okay, when we looked at those positions, our maximum percent if assigned, if the stock remained above our strike price, there's 9.4%, 9% for Royal Caribbean, 7.9%, and so forth, and we hit 6 out of 6 positions almost. Now, why do I say almost? Well, down here in our summary, we see 6 out of 6 positions were profitable, but this one here, this arch coal, I'm sorry, not the arch coal, I apologize. Let me erase the drawings there. Take a look at the Cummins position. Stock was at 46.74. We were going to sell the slightly out of the money 47.5 call for $1.90. The maximum return if we were assigned was 5.9%, but that didn't happen. We only made 2.7%. Why? Well, the stock dropped, didn't it? The stock dropped down about 70 cents, but we still kept all of the premium, so we did make $1.20 with the stock trading at 46.06, so we still made a return on that, but it was not the full return. We didn't get the full return if assigned, even though that position ended up being profitable. Okay, but we still had some good results. Now, in this scenario, as I mentioned, it's easy to see for ICI Bank, we opened the stock at 31.05. We were looking at the September 30 and the September 32 call, the 2 covered call combinations. Well, the stock ended at 35.41. Okay, so the stock had a nice about 11 to 12% move. So the slightly out of the money one would have been a better call just monetarily. We probably would have only entered one of these positions. But if we wanted to be more protective, again, the less in the money, the 4.7, would have worked out pretty well. So if I wanted to analyze my group results and say to myself, okay, if these were the 6 results I had and I was going to enter 6 covered calls, I wouldn't have entered 2 covered calls on ICI. What I probably would have done is decided to go with either the slightly out of the money for the higher return or the slightly in the money for the higher downside protection. Well, let's say that we were going to be aggressive. So what I'm going to do is click the checkbox here on our second ICI position, the 30 strike call that's deeper in the money, and I'll click remove. So now I'll just see the 5 results that I would have traded over that time period, and we can make a record of this. Of course, we had the 9.4, the 9%, 7.9, 2.7, and 5.1. Now, from this screen, I wanted to take a look. Let's say we wanted to take a look at that Cummins position here. Remember, our Cummins position didn't hit full fruition. We wanted to see maybe what started to happen in the stock. Was there a deeper decline in the stock over the time period? Maybe it dropped and came back up. So what we'll do now is, using that more information button from this calculate group results, let's go ahead and look at that analyze position field again. Okay, so there was something interesting here, wasn't there? The stock on September 1st, the covered call position on September 1st had its lowest possible gain. Had its largest loss. It was down 3.3% on September 1st. Well, now what I want to do is go ahead and use this information here to see what had happened on September 1st. So let me scroll back. Here's my return versus the change. And on September 1st, we see that the Q was down about 1.9% from when we opened our covered call position. SPX was down about 2.3%. There was a pretty big dip there, and that's when our percentage return dropped. Well, how far did the stock drop, and what happened to the option? Let's go back and remember we were looking at the stock, Cummins engine, when it was about $46.74 per share on 8/24. We sold the option for about $2. That was the closing price, of course. Now on September 1st, that was the date when we had our lowest return, remember, up here. We had that minimum return of minus 3.3%. Let's take a look at September 1st. Well, at the time, the stock had dropped down about 2 points to 44.08. Okay, so on a $46 stock, that's what the stock was when we originally opened it, and now it's down to 44.08. So we lost $2 and let's just say 75 cents. It's close enough to there. But a $2.75 decline on a 46.74 position, that would have been about a 6% decline in the stock price. Okay, so maybe that's not significant. Maybe that's not a point you would use for management. I talked to a lot of investors, of course, during the day, and a lot of customers I talk to will sometimes use stop losses. They might put an 8% or 10% stop loss. So this 6% drop still wouldn't have hit our stop loss. But the question is now, what if I would have done some management on this position? Remember, let's take a look. We originally opened the stock at 46.74, and we sold the slightly out of the money 47.5 call for $1.90. On that Cummins position, on September 1st, the option price had dropped down to about 70 cents. This is the closing price, of course, so it had dropped down to about 70 cents. If we would have bought this call back for 70 cents, we still would have kept $1.20 in premium, and maybe now we would have wanted to roll to the 45 call. Okay, so how can we look at that? How can we look at what the price was for that particular position on September 1st? Well, let's go ahead and take a look. I'm going to exit out of the analysis. Okay, let's go back here. And from my group analysis, I'm going to link from the Cummins engine position to the option chain. Now, when I have the historical suite of tools, what I can also do is go back in time and look at what all the different prices of the options were. Remember, the stock originally here, this is the original price. I'm sorry. These are the prices from when we opened the position on August 24th. That's what we're currently looking at right now. It linked us automatically to the date that we launched our search. And remember, there's our 47.5 call that we sold for $1.90. Okay? Now, let's say we would have considered rolling down the call after we had a 5.5% decline. Well, on September 1st, that's exactly what happened. There's a 5.8% drop. Let's go ahead and take a look at what the option prices would have been for Cummins engine on September 1st. We know, because we saw in the history, that the 47.5 call that we had sold had an ask price of 70 cents. Okay, so this is on September 1st. There's our 47.5 call. If I bought to close that call, I would have kept $1.20 of the original premium, and now, let's say I could have rolled down to a 45 call for $1.55. Well, I'm sorry, we'll take the natural bid price. I apologize. We'll sell for $1.40. So this means the total premium now that we would have had in the position would have been about $2.60. But I had agreed to deliver my shares of stock at 45, so that means the most I could make if the stock continued to go up above 45 between September 1st and the 19th, 18 days from now, we would have kept the $2.60 in premium from the original sale price, the buyback cost, and the new premium, and now that 45, getting assigned at 45, means we would have taken in about $47.60 when we originally purchased the stock at about, what was it, $46.74. So we still would have had a profit of a little less than $1, about 90 cents, if we had actively managed the position once our stop loss had been hit. Well, of course, many of you who trade covered calls might look at that and say, well, wait, if my stock dropped to September 1st, that's great that the September 45 call is still at $1.55 premium, but I might have probably rolled out to October and sold the 45 call in October because I'm going to go 1 month out. Okay, well, let's take a look there. Remember, it would have cost us 70 cents to buy back the original call, so we keep the $1.20 because we sold it for $1.90. We sell the October 45 call for $2.75. So this means we're taking in a total net credit now of $3.95. And if we get assigned later on in October for $45 per share, we take in a total of $48.95, okay, or what would have been a profit of roughly about $2.20 above that initial stock purchase price of $46.74. So how would this have performed going through October expiration? Well, let's just see what happened on October expiration. I'll go ahead and pull up October. Let's assume that we rolled to the October 45. Okay, and October expiration was the 16th. Where was Cummins Engine at that time? Oh, it was at 48.72. So at that time, we would have been assigned at our 40. If you rolled to the 45 there, based on those new premiums that you had collected, we would have kept about $3.95 there for the option premium total for both transactions, and you would have been assigned, and then you can calculate what the return would have been if you had rolled the position. Okay, so that's just how some of the historical option chain can help you as well. And we're going to take a little bit look at that later on too. Okay, so let's go back to our search screen here. And, once we go back, we've analyzed these positions. We saw what happened to Cummins, why it didn't reach its full profit. Would we have managed it at that point when it only dropped 5%? Personally, I would not have. Remember, I had mentioned earlier that if I use a stop loss on a covered call or a mental stop, it's usually only around 7.5 or 8%. So the stock never dropped that far. I would have actually just left it open. I wouldn't have made the maximum 5.9% because we did not get assigned, but I would have made that 2.7% as well. And if we want to run the last scenario, remember, that's fine. Let's go ahead and do that. We're now up to September expiration. Haven't really had a losing trade yet. I know this has to lose at some point, right? So let's go ahead and assume after September expiration on September 21st, again, we went ahead and selected our search settings. Let's go ahead and hit submit, see how many results come up. 5 results again, some of the same stocks, and that's not surprising. You'll tend to see that over time, whether a stock's trading in an uptrend or there's only a few stocks that match your restrictive criteria. But sometimes it's okay to keep trading the same stocks. Here's Navios again. Here's Cummins Engine is still there. Okay, it's dropped a lot though, hasn't it? This was a pretty down day, but remember we were looking at, we know what's going to happen to October, right? We know the stock's going to be at 48.74 because we just saw that using the option chain. But now we have Terra Industries and Aflac in here as well. So again, let's do our little calculate group results. These are the 5 covered calls that matched our criteria. Let's go ahead and run that. And again, this one actually looks like we had full profit. Cummins, we had a potential 5% return if assigned. We made 5%, 4.6 for Navios, 4.4 maximum, and that's what would have been realized on Terra. Aflac, 4.4 and 4.4, and Smith at 4.2 and 4.2. That's pretty good. We're still doing really well. And again, if we wanted to do the individual analysis, we could do that. We have our computations down here, the average at 4.5%, and so forth. Okay, what happened to the QQQs and SPX during that time? That's great. Okay. We didn't have any copies. I didn't have any different strike prices for the same stock, so we'll just go ahead here and we won't remove any of those ones, and we'll keep our list running, the 5%, 4.6, 4.4, 4.4, 4.2. I'm just jotting these down as I go. I haven't done this ahead of time, so what I'm seeing is the same thing that you're seeing. We're seeing this together, so I don't know what the results are going to be. We're going to run our list one last time, aren't we? Let's go ahead and pull up October. Okay, and we're not at November expiration yet. We're going to look at the month-to-month covered calls now. We're going to look on the Monday after October expiration, Monday 19th. Again, testing covered calls. Let's go ahead and hit submit. None. Wow, that's interesting, isn't it? We had no results on October 19th that matched this criteria. Well, what we can do now is say, okay, well, something's going on here. On October 19th, I didn't have any results that matched my criteria, and that was the Monday following expiration. Maybe the option volume was low. Maybe the open interest was really low, and there wasn't any stocks that traded 50 contracts or covered calls that traded 50 contracts. We know that's not true, but matching the rest of this criteria. Let's go forward. We're just going to go click on next. We're going to go to see October 20th. Nothing matches on October 20th. Now, does anyone know why? Well, one of the reasons might be, we reviewed these a little bit earlier. Remember that I had selected to only see stocks that do not have an earnings date between now and expiration. I didn't want any sudden surprises. Okay, so right now there are no covered calls that match my criteria that did not have an earnings date between now and expiration. Well, what if I wanted to see, let's go back to the 19th for a second here. I want to go ahead and go back to the 19th, the Monday following. We know I don't have any results that match the criteria, but let's go ahead and uncheck that box and see what comes up. Okay, so I'm going to uncheck the box. We're going to run our search on October 19th using the same criteria, but we're allowing stocks that did have an earnings date between now and expiration. Okay, now here we go. There's Vail. That was one of the ones that came up on our real-time search when we just pulled up in the basic search. Here's Aflac again. I've got JCPenney, Frontier Oil, PFG, some good name stocks here. But we had an earnings date between now and November expiration. We're not at November expiration, but we can still calculate the group results to see how everything worked out up till today. So let's go ahead and click Calculate Group Results. Let's see how our winners and losers record were here using that testing covered calls search criteria. Yipes. This is one of the reasons, by the way, that I usually look for covered calls, naked puts, bull put credit spreads that do not have an earnings date between now and expiration. First position, we have no gain and no loss. Isn't that great? Bought Temple Inland at $17.66. Sold the 17.5 for $1.45 in premium. Net debit of $16.21. As of the close today, the stock's at $16.76. And it would cost us 55 cents to buy to close our call, liquidate the stock for a liquidation value of $16.21 or 0.0%. Okay, what are the two big losers here? Ooh, JCPenney, huge loss, 15%. Frontier Oil, FTO, 9.6%. Well, again, this allows us to run those scenarios just as we did before to see what happened during these positions and what management might we have done. Well, the first thing I'll do is let's go ahead and check JCPenney. Remember what I'm going to do first? I'm going to go ahead and click the little blue button, the More Information button. We want to analyze the position. I want to see, wow, today is the lowest date. So the stock, our percentage return has just been declining. It has never been positive, it looks like. Yeah, the max return on 10/22, this was about 3 days after we opened the position, was 0%. And ever since then, our percentage return has just declined and has just been continuing to move down. Well, was it the stock? Was it the change in option? No, it's pretty much the stock price, isn't it? Let's go back. Our opening day, we looked at JCPenney at $36.57. That was the opening on 10/19. And since then, the stock has just dropped and is now trading at, trading below 30 actually. JCPenney's now at $29.39. Well, that's interesting. Does it look like there was any one event that caused this? Well, the biggest gap here appears to be this $2 gap between 11/4 and 11/5, November 4th, November 5th. The stock dropped from $32.08 down to $30.32. So that's a pretty decent gap. Let's see, where's the bigger gap over here? Yep, there's another one from 31.15 between 11.10 and 11.1. So now one of the features that I might want to take a look at, I want to take a look at the stock chart there. Let's leave this analysis page for the moment, the originally analyzed position. I'm going to go back here. Let's go ahead and go to the stock chart, and I'm going to link to big charts for JCPenney. I want to see if there were any events that occurred. Okay, here's just a standard chart, and we see, of course, we would have opened the position. Let's do a 3-month chart because we're only looking at a shortened time period. Let's go ahead and pull that up, okay? So we see here right about after October expiration, right around this time period when the stock was about $36.57, this is where we entered the trade. It was a terrible choice for a covered call. Was it the earnings that had an effect on this, or was it declining before then? Let's go ahead and take a look at our indicators. I'm going to show all events. Hold on, I apologize. Give me 1 second here. There we go. Show all events in big charts. Let me go ahead and draw the chart. How about that? We haven't even hit the earnings yet, it doesn't look like. The earnings date must be coming up soon. So we haven't even hit the earnings date yet, and the stock has just steadily dropped. So remember, if we were let's say, I was hoping to see that it was an earnings event that might have caused that. I guess it wasn't. So let's go ahead. Now I'm going to close big charts down. Let's go back to the screen here. Oh, I'm sorry. I accidentally clicked something there on the side of the screen. Okay, so we're looking at that position. Frontier Oil now. I want to take a look at that stock chart because it dropped. So we want to see if the earnings event was part of the catalyst that might have caused that one. I'm going back to big charts. Let me pull up the 3-month chart there. Go ahead and draw the chart. I also want to see my indicators here. I want to see if the earning, it doesn't look, there looks like there was a couple days when it had a strong decline and then it's been moving down since then. Let me take a look here at the events. Big charts is thinking. Let's give it a minute here. There we go. Okay, so on this date here for Frontier Oil, we would have opened the position, remember, right around October 20th, which I think would have been right about in here. Okay, when the stock, I'm sorry, let me navigate back. What was our stock price at Frontier? It was $15.42, okay? So right about around this time period is probably when we got into the stock position. The earnings date was here and it was down, so that's why we saw the last decline, but the stock was continuing to move down over this time period. So why am I showing this and why am I looking? Well, I wanted to see if it was an event that caused this, a specific event. I would also probably link back to the company information, the news, and the headlines to see if there was any single event. Of course, Steve, yes, you pointed out that JCPenney was probably bad because of the retail sector as a whole has been bad and lower expectations for the retail sector. Frontier Oil is not retail, but it still had a significant decline. But why I wanted to look at the charts, of course, was remember we were talking about if I was using, let's just say, a basic 10% stop loss. If I had bought Frontier at $15.42 and I had used a stop loss of about 10% when I'd managed the position, well, as soon as the stock had dropped to about $13.90 or about $13.95, $1.50 below our entry price, that's when we would link back to the option chain now. I'd go for, let's go for the analysis position page first and see when did the stock price, let's say we're using just $14. Or I'm sorry, $13.90, roughly around that time period as our stop loss. Well, right around that time period between 10:29 and 10:30, that's when the stock dropped about $1. So on October 30th, we probably would have taken action. We would have had our 10% stop loss. So now we can link back to the option chain for October 30th. Happy pre-Halloween, of course. Let's go back to our screen here from the group results and then link over to the option chain for Frontier Oil. This pulled up from October 19th. Remember, we want to see the prices on October 30th. For the chain. Here we go. The call that we sold had declined in price. Wow, I forgot to look at that. It was the 17.5, wasn't it? I'm sorry. No, it was the 15. Okay, so we were slightly in the money. Our 15 call has now dropped to 40 cents. If we stayed in the November time period and sold the $12.50, rolled down to the $12.50, would have collected about $1.60 in premium. So that means we would have collected an extra $1.20 from the difference in the ask price, of course, to the bid price. And what we received from the premium before was $1.05. Okay, so we had $1.05 initially, bought back for 40 cents, would have kept 65 cents, rolled down maybe to the $12.50, and collected another $1.60 in premium, so the total there would have been $2.25 income on the $12.50 strike. So adding that up together, what do we have? We have a total of $14.75. Well, that's not good because that was below our cost basis, wasn't it? We originally bought the stock at around 15. So this would have been a negative return if assigned, rolling down to the 12.5 if we went through to today's date. Let me go ahead and click on current. Let's see where we are now. So yeah, we're still at $13.04. So the $12.50 is still about 50 cents in the money. We might expect to get assigned in the next 9 days, but that would have caused us to roll down for a loss because our original cost basis was higher than the new potential return we'd make if we got assigned at 12.5. And again, you can also go back to that date. It was October 30th, and we could have said, well, we hit our 10% stop loss on the stock. instead of rolling to the same November 1250, what if the same month in November, just roll down. If we rolled to the 1250, if we went out to October, we really would have only made, if we rolled out to December, this is the problem I have when I talk about the historical tools. I start talking about months backwards. But if we rolled at that time on October 30th out to the December 1250, we would have only made 25 cents extra. Possible 160 premium for the November and 185 for the December, and we'd still be about 50 cents in the money. This $1.85, that extra 25 cents, would have only put us at a cost basis, a total potential, I should say, of $15. The 12.5 strike plus the $2.50 in premium we would have had there. But remember, the initial cost base of our stock when we opened the position was $15.42. So we're still looking at getting assigned for a loss, a value that was below our initial cost basis. But of course, we could continue to roll it. But what we're trying to look at here is why we do certain things. Now remember, we had a good track record up until this point using just that basic search screen. We did not have a loss up until October. But remember, when we originally ran our search, I'm sorry about that. We originally ran our covered call screen in the back testing on the October expiration date. What did we see? We didn't have any results because our method, we were looking for positions that did not have an earnings date between now and expiration. So when we ran that, we did not have any results. As soon as we opened that up, we had 9 results in there. But we had some significant losses because the market as a whole and some other earnings surprises. So does this mean it's always good to avoid positions when you're coming into an earnings season, or avoid covered call positions that have an earnings date between now and expiration that match your criteria? No. There will be some stocks, of course, that are going to move up in price because they had very promising earnings between an expiration period. You might get assigned for the value that you wanted. But in this example, it does show that it would have been better actually not to trade at this time. It would have been better to stick with our methodology and not enter any covered call trades for October, because if we removed that filter where we weren't allowing stocks that had an earnings date between now and expiration, we would have racked up a few significant losses on those positions, only had 2 profitable positions at the time. Of course, we still don't know what's going to happen in the next 9 days, but just looking at it that way, we would have been better off not entering into those covered calls that match the rest of our criteria that did have an earnings date between now and expiration. Now, of course, I know what some of you are thinking. Well, of course, Mike, you're going to be profitable in the last 4 months. Heck, if you showed us an example where you ran this covered call screen looking for stocks that had a good return and a good downside protection, maybe the last 9 months, you would have had a good return since the March low. And that's true, but we just wanted to show an example of how you can use these tools and how useful they can be. You can tweak your criteria. Let's say you started off with just a basic set of criteria that you wanted to backtest, and let's say you had 25 results or so that matched your criteria, but when you calculated the group results, only 2 of those 25 were profitable. Well, that kind of gives you a clue that there's something you're going to need to do. Either you're going to need to develop a better management for the 23 out of 25 positions that lost during that time frame, or you're going to have to really start tweaking your criteria, start playing around with new things to see what would have worked better in that market. Okay, I had mentioned earlier that one of the other features, of course, was the historical search by symbol. Let's just look at bull puts, for example. Let's take JCPenney. That was a pretty good example. What I want to do is I want to go into the back test for bull put credit spreads, and we're going to go ahead and go into the search by symbol screen. And let's say back in October again, the day after expiration, so I'm going to select October 19th, and I'm going to look for, I'm changing the expiration month, so I'm selecting bull put credit spread, October 19th, that was the day after expiration. The expiration month here, I'm telling the system, show me just those bull puts on JCPenney that expired in November, that had a November expiration. For right now, I'm going to leave this little filter here. We have some hidden filters to look for less, more, and all results. I'm going to go with the more results, and then I'm going to type in JCPenney. Okay, we're going to see all possible bull put combinations that might have come up on JCPenney on October 19th. Wow, there's a fair amount of positions there. Well, what are we looking at here? Well, this is a helpful screen, just as a standard search by symbol tool is. This is a very useful screen to help me compare what I would use to analyze a position. I analyze potential bull put credit spreads that I would get into. Now up here at the top, this is a little bit ridiculous, and it looks good. Okay, so this first spread is I could sell almost the at-the-money November call, the 36 for $1.45, and at the same time buy the 35 put for $1.15. This would have resulted in a potential credit of 42.9%. We had only had a probability of 55.2%. Okay? Well, let's reverse that. If I wanted to have the higher probability, let's say I went with the 91.7% probability, well, that's great. With JCPenney at 36.57, could have sold the November 31 put for a measly 25 cents, bought the November 25 put for 15 cents, very basic net credit of 10 cents, but since this is a $2 spread, that would have offered a 5.3% return, and we had a 91.7% probability of staying out of the money. Well, we know what happened, don't we? Let's go ahead and calculate group results, and of course this should show us what we expect to see from what we saw in the decline at JCPenney, is that none of those spreads should have given a profit. I don't think any of these spreads are going to be profitable right now. Maybe that 31.29, but I doubt it. Let's take a look. There we go. Whew. Significant losses, huh? Here's that first spread. The first one, the 36, remember we looked at, and the 35. Selling the short option for $1.45, and we paid $1.15 for 30-cent net credit. The stock's now at $29.39. It would cost us $6.70 to buy to close the 36 put, and we could get $5.60 for selling to close our 35. So this results in a net value of $1.10. We only received 30 cents, so we're essentially looking at a loss of 80 cents on that position. Okay, and even our higher probability trade, when we had a 91.7% probability, the November 31, the November 29, we only had a 10-cent net credit. Right now it would cost us $1.25 to liquidate that position. So that would be a pretty significant loss, wouldn't it? Okay, so but this does allow me to see what kind of positions may or may not have worked. Let me think here. Let me go back. Let me go into the search by symbol for the bull put credit spreads. Okay, and instead of JCP, I'm going to look at Fossil, because I think Fossil has done something a little different. I'm going to keep the same date. We're going to search on October 19th, leave the results for November, or the expiration for November. And we have more results, so we've got some combinations. On October 19th, Fossil was trading at 30.32. Okay, we had a couple combinations here, some decent returns. We could sell the 30, it's the at the money, for $1.40. Bought the 25 for 30 cents, net credit of $1.10, or a 28.2% return. The second one, you might look at that and think it's interesting. We have a higher net credit but a lower return. Why is that? Well, we're still selling the 30, but we're looking at the 22.5. So the problem there is that we now have a 7.5 point spread. We have a larger risk. So even though we increased our net credit, we do have a larger risk. Okay, both of these have a lower probability, 53%. And then, of course, the other position, we have a 91.8%, but that's basically nothing, isn't it? You might be wondering, why isn't there a 25 or 22.5? Let's see if we go to all results. Maybe we can see the combination for the 22.5 spread there. Nope. Okay. So the 22.5 spread probably wasn't built because there was no volume on the 22.5 call that day. Okay? All right. Now, or it's possible that there wasn't a positive net credit. This one here only offers a 5-cent net credit. But let's calculate group results, see if any of these are profitable. Well, how about that? The 30 strike puts, because the stock has moved up to 31.24, those at-the-money combinations still look good. But I want to see something here. I want to take a look at that analyzed position for that first spread there, the 30-25, the 5-point spread. And that's what I wanted to see. See, at one point here, even though this bull put credit spread has it's profitable right now at 19.2%. The max we saw yesterday was at 20.5% because the stock had a large gap up. We wouldn't probably be in this position, would we? If I was in this bull put credit spread on October 30th, that position was a 56% loss for me. So now it's kind of time to gauge your quote-unquote constitution there. What do our guts really show us about this trade? what would our stop loss have been? Where we would have managed the position? Again, if I'm in a bull put credit spread and I maybe set a 10-point stop loss or 10% stop loss, I would have opened Fossil at 30.32, so I might have had a $3 stop in. So if the stock hit 27, that might have been when I moved to close. And as we see on 10.28, that's when the stock dropped down to about 26.87. So we probably would have rolled the position on 10.28 for a 47.4% loss. Now, you might do some different management on a bull put credit spread. For example, on 10.28, when the whole position was down 47.4%. Remember, our stock itself had dropped down and maybe hit our 10% stop loss of 26.87, so we would have moved to make an adjustment. We might not have liquidated the position entirely. What we might have done is bought to close the short put on 10.28. Okay, so we could buy to close the 30 put on 10.28 as the stock declined, and then left open the 25 put to see if we could get further value out of it. Now remember, we originally received a net credit of $1.10 on this position. So the combined 25 and 30 spread was $1.10. Let's close out the analysis. I'm going to link back to what? I'm going to go back to the option chain. And let's take a look at what the 30 strike put was priced on October 28. You help us with some of our management, okay? All right, October 28th for Fossil. We want to know what the 30 strike put, and I'm on the call chain. That's not going to help us. Let me link over to the put chain there. There we go. That's better. Oof, pretty significant. So on October 28th, remember we collected a net credit of $1.10. The stock is now trading at 26.87. Using the closing prices, we have a bid ask of 330 and 360. So if we bought to close, let's just take the natural ask at 360, we'd have a loss of $2.50. But all we did was manage the short put, which is our obligation for the bull put credit spread. We're leaving open the 25 put in this scenario because we want to see a couple days later what happened. Well, let's go ahead and click next. Okay, so now the stock started to move back up. Our 25 put now has a bid price. Remember, we bought this put, so we'd most likely sell at the bid price when we sell to close, and that would be 50 cents. What was it on the 30th there? It came back up to 60 cents. And then as we go forward, I believe the stock started to move up after this. There it is. It's a close at 60 cents again on November 2nd. I want to roll to the next again. Here we are at 50 cents. So this one probably wouldn't have worked out. The most we could have gotten would probably have been around 60 cents, maybe 70 cents. Oops. But that would have put our total loss at about $2.90. So we still would have had a significant loss. The hope is here, when I apply that management to a bull put, is that the stock continues to go down. If it continued to decline in price, maybe drop down to $24 or $23, I could have made back some of that significant loss I took by using the option chain to analyze what the 25 put would have been priced at. Okay, so we've got a chance here to review all three tools and the historical suite of tools. We looked at the search tool to help fine-tune our criteria, what may have worked, what might not have worked. You can go back in either of the tools, the historical search, the Smart History Excel tool, the historical search by symbol tool, or the option chain. You can go, wrong field, you can go all the way back in time and run scenarios back to April 27th, 2006. So that's almost 2.5 plus years of data there that you can review through. Okay, it's a lot of historical data. Okay, let's just navigate back here for a second. And oops, sorry about that. So, we talk about the historical options chain. That's what I wanted to look at now. You can review the changes on the option price. This is one of the things I was hoping to get to, but we didn't get a chance to. I have a lot of customers who will come in and, as we mentioned, they'll say, well, I had a long call, my stock went up, but my option price declined. Why? Well, that's what's great about that historical option chain, is that you can look at all of the data that we have, all of the different data for Black-Scholes values, implied volatility, volume, open interest, gamma, theta, vega, and rho. And if you think that an option is not performing the way you'd expect it to, that historical chain can help you identify why. More than likely what happened is when you bought the call option at one point, you had an increase in implied volatility, and as the stock started to move up, the implied volatility dropped. So even though the stock was moving up, your call option lost premium. Okay? And it can also help you if you wanted to know when I saw a stock move, or I always heard this on the news, what could I have done with a particular option? Last month I heard about this NRG, for example, that was going to buy blue water wind power, and I wanted to know, okay, what kind of option plays, what kind of call premiums could I receive if I traded NRG that day before the news came out or before the deal was finished? That's what that historical options chain can help you do. And as we showed, it can help you evaluate the what-if scenarios and management, but try not to dwell too much on what could have been. We analyzed that CMI position. We took a look at why we hadn't yet made the full return on CMI between, I believe it was the September-October expiration. Well, it was because the stock fell a little bit, our call would have expired, we only would have made that 2.7%, I believe it was. And so what ends up happening is that we start thinking, oh, well, how could I have made 4%? How could I have made 5%? Don't dwell too much on what could have been. 2.7% was still a pretty good return. All right, so the historical suite of tools, as I mentioned earlier, they're not available on the regular subscriptions for the 20-minute delayed, the PowerOptions plus 20-minute delayed service, which is $59.95 a month, and it's not available on the regular real-time subscription, which is $79.90 a month. You can get a quarterly unlimited access to the historical suite of tools. It's $99.95 for a 3-month subscription to help you fine-tune your criteria and different strategies and do the different analysis and management. But if you're already on the real-time service and you want to test out the historical suite of tools, it's actually better just to upgrade the professional level of service. See, if we look at it this way, the quarterly access at $99.95 for a 3-month subscription, that works out to be about $33. If you're already on the real-time service at $79.90 per month, just upgrade to the professional. It's only costs $20 more. The professional level of service gives you access to everything you have on the real-time service, plus unlimited access to the historical suite of tools. So maybe for a month or two, upgrade to the professional level of service. You'll have full access to those tools, and it's only about $20 more. Okay? And again, I'm going to stay around. I know I've gone a little bit over time. I'll field any questions if you guys have them. We're a little bit past 7 o'clock, but if anyone has any questions, I'll be more than happy to answer a couple. But I also want to leave this screen up. You can email us at any time to support@powerop.com. You can also call us toll-free from inside the continental U.S. during market hours at 877-992-7971, or reach us at 302-992-7971 if you live outside the continental United States. Of course, there's contact links on every Power Options page. All right, so I'll see if we have any questions. I think Greg was helping me out and answered some questions that were coming through during the presentation. Greg Zorana, of course, the Vice President of Power Options. I've had the great pleasure of working with him and Ernie for the past 7 years or so. Okay. Yeah, Steve, I'll show that. I'm sorry. I forgot to mention that because it wasn't really what we were looking at. Steve's joining us tonight. He's a current member of Power Options, and he's been providing us with a lot of useful feedback on some of the tools. And I think I just closed the wrong window. Let me go back here. And what we looked at recently is for those of you that are using the portfolio tools to track your positions, and one of the features that you can do in the portfolio tools is you can set alerts, whether you want to be alerted if the stock moves up 5% or down 10%, when you're tracking a trade, for example. But what we added here is an alert summary page. I'll just click on that. And this is a new feature we just added. So instead of going through your portfolio and checking each one to see if an alert has been hit, this little alert summary page shows you all of the alerts that have been hit in all of your portfolios. So you see my portfolios. Here's my webinars portfolio. It looks like 3 different alerts were hit on my positions. I have a collars variety. This was for our collar strategy discussion. I had 3 alerts hit there as well. The open discussion portfolio, I put in some stop losses here for the if the stock moved up more than 7%, or if the it looks like here, it's for the same bear call spread, if the stock limit had been hit, so those 2 were hit. And then in my vertical spreads one, the SCHN one was hit as well. So yes, Steve, sorry about that. I think we were going to send you an email. We wanted to make sure it was functioning properly. We put this up probably right around 4 o'clock. I didn't get a chance to test it, actually. The program, well, I didn't get a chance to test it till about 5:15 before the webinar tonight, so I didn't get a chance to send you an email about that. But it's a very useful page because we talked a little bit tonight about setting alerts for your different positions, what you want to look for. You know, if you're doing covered calls, maybe you set a 10% stop loss, for example. But you see here in the portfolio, let me go back to that webinars portfolio, I'm sorry, where a couple of my positions were triggered. You see here my Coca-Cola position, scroll down a little bit, there we go. My Coca-Cola position is highlighted in red. That's to let me know that that alert has been hit. But if I wasn't in this portfolio, you know, I actually would have actually navigated to this portfolio to see these alerts were hit, and that's why that alert summary page was designed, to help you with your open positions. This doesn't really help with the historical positions. It can help you with your management analysis, but this is for the open positions, or paper trading positions as well. Okay. All right. Well, we're about 5-6 minutes over time here. I don't have any other questions coming in. So if you guys have any questions later on about the historical suite of tools, please feel free to give me a call tomorrow during market hours or send us an email, and I'll be more than happy to answer them then. Thank you for joining me. This presentation was recorded and will be archived in the menu, the webinar archive menu here in the Learning Center. If I go to Learning Center and I go to Webinars, there is our current upcoming webinars in our archives. This one probably early next week will be archived in the Options Strategies section. And it'll probably go in the Tools archive. I'll probably put it in the Tools archive there. So look for that next week if you wanted to review the information that we shared. But just give me a call or send me an email later on this week or next week if you have any questions about the historical tools. Thanks again for joining us. Everyone take care. Happy trading. We'll talk to you soon. Good night.